Welcome back to the final segment of the Retire Young radio show. I am your host, Joshua David, having a great time spitting some game on the financial markets, how they work, and how us as the public can also participate with the smart money. Also, don't forget to subscribe to the Retire Young podcast on Apple Podcasts, iHeartRadio, and Spotify. If you're just tuning in, Al was shedding some light on retirement accounts, and retirement and techniques that the smart money is using with their accounts that they're not putting their clients in. So if you have an advisor or a broker, they're typically doing something different on their end than they're putting the public into different strategies. And really, technically, it's the buy and hold strategy, which is a one-direction strategy. Now, he talked more about self-directing and how important that is. And I want to get into and just continue that out with the fees. You mentioned there's a lot of fees with mutual funds and with brokers and advisors, and there's a lot of people that are finally understanding that. And I've had a lot of conversations with some different friends and talking about they want to be able to create their own retirements and lower those fees. So real quick, just explain some of those fees that may not be disclosed or that are included with mutual funds and managed money, and then explain after that down markets, how to participate, how great down markets actually are.
Yeah. Well, as far as the fees are concerned, basically in an employer-sponsored retirement plan, here's the bad part about those. You're paying fees for little to no advice or counsel. You're really making the decisions on your own. And those fees have a double impact on you, double negative impact. Number one, every dollar that is taken away from you in a fee is no longer in your account. But worse than that, it's not there compounding. And we all know the value of the magic of compounding. And over time, that can have a huge impact on what you could end up with in your retirement accounts. And we've done this before where we've shown examples where over the course of your maybe 30 years or so of working, fees that can be as small as maybe 2%, 3% can take hundreds of thousands of dollars away from what you could have in retirement. And that's a significant amount of money. The fees that we're talking about, especially in mutual funds, and mutual funds are the go-to investment in retirement accounts, in 401ks, 403bs. Why? Well, I mentioned this before. Number one, the brokers, the financial advisors that put those together get paid an ongoing amount of money, an ongoing commission for having those mutual funds in your accounts. A lot of advisors will do what we call revenue sharing, because if you look at several different 401ks or 403bs, they don't all have the same mutual funds in them. So how do these companies decide which mutual funds to include? Well, the mutual fund companies basically will pay the financial advisors to put their mutual funds into their retirement accounts. So there's a cost there. Who do you think ends up paying that? But there can be administrative fees, legal fees, transaction fees, marketing fees. Who do you think pays for the salary of a mutual fund manager?
The public does.
Yeah, and that is not a minimum wage job by any means. So that's all coming out of your potential returns. When you have a self-directed account, the only person that you're responsible to is yourself. There are no fees that you're paying. You can participate, again, as I mentioned, in the three different directions that the market goes. If you're only participating in a one-direction type of an asset, which is typically a mutual fund or the choices that are in your employer-sponsored retirement plan.
Even stock. They have stock
and
choices.
Stock. The only way you're
direction.
going to make money is if that goes up in value. Well, what happens if it goes down in value? Then the value of your account goes down. But guess what? You're still paying the fees.
It's not what happens when, it's when.
It's when.
We know it always goes up, it always goes down. So that's why it's important to have a three different ways strategy.
Correct. In the actual the corrections that we go through, that's a 10% drawdown or more. Corrections are a normal part of the market, and on average, we have one every 11 months or so. These last few years, we've had several within each year, but that is a normal part of the market. We're always going to have those. Every so often, every maybe 3 years or 5 years, we'll have a bear market. That's a 20% drawdown or more. Every time you go through something like that, it not only takes money away from you, but it takes time away from you because your portfolio has to grow at a greater rate just to get back to where you were before. It may take, what if it takes a year or 2 years or 5 years just to get back to even?
That's the key is you don't get time back. And, Al, you talk more about like the fees, the downfalls in some of these different assets, the mutual funds and everything. And, there's a lot of problems, and people can't retire. That's part of the reason. Kind of back up a little bit as well. You were talking about the lost opportunity with mutual funds. I mean, hundreds of, a couple $100,000 over a 30-year investment career, we'll call it. Now, that's significant. Think about this. That's significant because most of the public only has $100,000, $200,000 in their accounts. They don't have the money that they need to retire. So they're losing so much opportunity, and that's why they can't retire. Let's get into a plan. Now, there's a lot of people that are listening that want to understand, hey, how do I get started? How do I self-direct? What can I do? Where should I go? What are the opportunities do I have? And how do I learn that with confidence?
Right. Well, one of the things that we do in these classes, Josh, is we talk about retirement accounts, and in some of our classes, we do what we call dynamic 401k management. So we can show you how to maybe get better returns or the opportunity for better returns out of your 401k, 403bs, how to maybe make better choices. And maybe there are some things in your portfolio that have lower fees. Identify those, and maybe those are ones you want to stay out of. But you mentioned confidence. A couple things you mentioned I really want to talk about. One is confidence. And how do you get confidence? Well, you have confidence when you know what to do, you know how to do it, and you know why you are doing it. And you get that by, number one, having a solid strategy. That's our core strategy for our students, which is basically a timing mechanism. And then using the right tools, and then understanding how to keep emotions under control. That's all part of a plan, by the way. The only way you're really going to keep emotions out of your decision-making process is to have a plan that includes a set of rules you follow. We want to keep this more methodical. Take the thinking out of it, the emotions out of it, follow a step-by-step rules-based process that is objective in nature, and that keeps the number one enemy of any investor or trader, that's yourself, keeps you at bay as much as possible. We talk about the right tools. I know, Josh, you're a golfer.
Correct.
If you
try to be.
You're okay. Let's maybe not even call it a golfer, but you swing clubs.
I go out a lot
and destroy a lot lot of grass.
Hey, no.
But if you were in a tournament, would you enter a tournament and play the whole tournament, all 18 holes, with a putter?
I would not.
No, you have a different club for different situations during that tournament, right?
Mm-hmm.
And the same thing is true in the financial world. There are different assets, different strategies to use at different times. So the right plan should not only include that basic timing strategy, but also access to the right tools, the right assets to trade during different market conditions. That's really where the confidence is built up. And then you had mentioned before managing your capital. That's managing not only your wins, because sometimes you'll be right, sometimes you won't. So it's managing both sides of that to your advantage. And that's all part of that plan also. It's controlling the initial investment. It's controlling the potential profit part of it. And then any time you're wrong, you want that controlled or managed also.
Yeah, it's all about having that proper strategy. You mentioned the core strategy, and we talk more about the core strategy in these investing classes. But as Al was saying, it's a step-by-step, rules-based strategy to make better investing decisions. And if you don't have a strategy, you have to learn it. And trading and investing, it's not just knowledge, but it's also skill. And that's where the knowledge starts, is in these investing classes. Learn some knowledge, some vocabulary, what shorting really means, what ETFs are, what Forex is, what stocks are, options. There's a lot out there. You can simplify it, but just by learning it the proper way. Al, let's hit him up with some of that good old words of wisdom.
Well, remember, your actions are responsible not only for what's happened in the past, but also the present and the future. If you aren't happy with what's happened in the past and you want the present and the future to be different, your actions have to be different. Well, if the difference you want relates to your finances, get the proper education. Take that first step. One of these free classes just might be that first step for you.
It's just sometimes learning something new. These aren't different. These techniques, these concepts, they're not new. They're just different. Next week, we're going to talk more about retirement accounts and techniques and strategies, more on the futures market, the Forex market, and options. Also, we're going to get into shorting, how the markets move up, how they move down, the different techniques that the smart money is using that is also available to the public. Don't forget to subscribe to the Retire Young podcast on Apple Podcasts, iHeartRadio, and Spotify. Until next week with the Retire Young radio show, retire young, my friends.